you are purchasing a property and require a mortgage, start by checking the tables on our website for updated rates. Your loan is essential to making your home a reality, so make sure you get it right. Our ranking table will help you find and lock in the best rate from here to your dream property, as well as other important information like how the market works, once you have selected a type of mortgage that works for your loan needs. Luckily for you, core member, we've prepared all you need to know about the real estate mortgage rates for 2022. Remember that while the first step is completing any of these amazing courses, the second and possibly more important step is taking action even if it's imperfect action. On Friday, June 17th, 2022, the average APR on a 30-year fixed-rate mortgage remained at 5.899%, while the average APR on a 15-year fixed-rate mortgage fell to 4.922%. The average APR for a 5-year adjustable rate mortgage, ARM, fell 13 basis points to 4.301% according to the data provided to NerdWallet by Zillow. The 30-year fixed-rate mortgage is 23 basis points higher than 1 week ago and 299 basis points higher than 1 year ago. These rates are based on national mortgage data provided by lenders to Bankrate.com, which, like Next Advisor, is owned by Red Ventures. These rates provide users an idea of the average rates they could qualify for when comparing lender offers. We feature both the interest rate and the annual percentage rate APR, which includes additional lender fees so you can get a better idea of the overall costs of a loan. The actual interest rate you can qualify for may be different from the averages coded in our table. Nonetheless, these rates help consumers compare loan offers by providing them with a sense of how different types of mortgages and repayment terms impact their interest rate and APR. These words might be foreign to some beginners, so let's tackle first what a mortgage is. Most people cannot afford to buy a home outright. Instead, they use a loan to purchase a home. After making payments of anywhere from 3% to 25%, they receive a mortgage to cover the remaining costs of purchasing the home. With mortgages that are set up in a 30-year term, you pay down the amount borrowed over a specific period. Term is the mortgage setup, so you pay off the loan over a specified period. The most popular choice is the 30-year dormancy. This includes payment of principal and interest, property taxes, and if needed, mortgage insurance. Homeowner's insurance may be included, or a homeowner may pay the insurer directly. Principal is what was borrowed, while interest is what still needs to be paid back on it. The mortgage rate a lender offers you is determined by a mix of factors that are specified to you and larger forces that are beyond your control. Since lenders place risks into the algorithm, they will have a base rate that takes the big stuff into account and gives them some profit. They adjust that base rate up or down for individual borrowers depending on perceived risk. If you seem like a safe bet to a lender, you're more likely to be offered a lower interest rate. These are the factors you can change. Number 1, credit score. Your credit score is used to determine risk. A higher credit score is more likely to mean that you will successfully make your mortgage payments. Number 2, down payment. Making a larger down payment on your house will reduce the amount of debt you're taking on and make you seem less risky for lending institutions. You can calculate your loan-to-value ratio to do this. Anything from 80% or more is considered high. Number 3, type of loan. If you're applying for a mortgage, the kind of loan you're submitting matter. For example, jumbo loans tend to have higher interest rates. Number 4, what your home is for. Mortgages for primary residences, which are where you plan to live, typically receive lower interest rates than those for vacation properties, second homes, or investment properties. Your mortgage rate may not always reflect the available rates. When comparing mortgages, your best bet is to check what your lender offers in that particular time frame or get an average from multiple lenders such as those provided by Zillow. When someone looks up mortgage rates and sees the information, those are not irrefutable facts. Those rates are generated through a sample of factors including location, credit score, and down payment amount. Sample rates also sometimes include discount points, which are optional fees borrowers can pay to lower their interest rate. Including discount points will make lenders' rates seem lower than they actually are. To have your loan rates customized, you need to provide some personal information about you. For example, if you enter your zip code on the homepage, you'll see codes that are more effective than the averages on this page. On the next page, you can adjust your credit score and the amount of money that you want to spend to generate codes that better suit your individual situation. Whether on a lender's website or here, interest rates vary. With this in mind, there's value in comparing across different lenders to get the best rate. Small differences might not seem like they would significantly change your monthly mortgage payment, but you're actually lowering the total amount of interest you'll pay over the life of the loan. The best way to get a loan is to do your research and apply for pre-approval from at least 3 lenders. With this, the lender will be able to verify your information and help you compare rates with other sources. Plus, it's easier for them to calculate fees because the pre-approval has already standardized that information. When comparing interest rates, you'll usually see two numbers: the interest rate and the APR. The APR, or annual percentage rate, is usually higher because it takes into account both the interest rate and all other fees associated with the loan, the fees charged by a private lender. Because of this, APR is typically seen as an accurate measure of the cost of borrowing. What do the experts say about mortgage rates? The cost of mortgages could go up or down as a result of a number of factors in the market. The rate has been rising due to inflation and the Federal Reserve's decision to raise rates. After the most recent hike, rates moved again. A rise in mortgage rates is due to inflation producing more interest by the Fed, who increased rates by 50 basis points in May and by 75 points in June. Mortgage rates unexpectedly shot up after the inflation report and just before the Fed announcement. Jacob Channel, senior economist at Landing Tree, said some lenders had already anticipated that the Fed would raise the interest rate 75 basis points and so were preemptively raising mortgage rates. A growing number of people are unable to buy homes because of high monthly mortgage payments and rising home values. The real estate data firm Black Knight reported the average monthly payment on a 20% down payment is more than $600 higher than at the start of 2017 and nearly 80% higher than before the pandemic. According to an analysis by Texas A&M's Real Estate Research Center, buyers now need to make $10,000 more income in order to qualify for a mortgage loan on a $229,000 home compared to year-ago values. As mortgage rates rise, the amount borrowed for a home also goes up. This compels buyers who wish to purchase a similar-priced home to earn more money in order to live within their budget, explains Claire Lozzi from the center. How important is it to shop for multiple quotes? Many financial institutions offer mortgages. It is important to get quotes from a variety of lenders to find the best offer with the lowest rates and fees. Home loan seekers should compare offers from lenders that differ in size, reputations, and offerings in order to find the best option for them. The difference between two premium options could be as high as 0.75% according to House, a fintech startup that empowers consumers to compare loans side by side. Although the interest rate is an important factor to consider, you should also compare the fees and rates offered by different lenders to make sure that you're getting the best deal. To find a great mortgage lender, check whether they're willing to provide a loan estimate within 3 days of when you submit your application. This standardized form makes it easy to compare quotes for all lenders. What is the impact of a good mortgage? A mortgage rate is the interest you pay on the remaining loan balance. In fixed rates, interest rates are unchanging and this feature comes with a limited amount of time. Adjustable rate mortgages (ARMs) usually have 3 to 10 years where the interest rate will reset every year after the introductory period. With a longer mortgage period, the overall interest in your loan will rise. A $300,000 30-year fixed-rate loan at 4.5% and 5.5% would result in these equivalent yearly payments for a period of 10 years. Here are the mortgage rate trends for 2022. Experts are expecting mortgage rates to rise throughout the year of 2022, though with plenty of ups and downs along the way. Rates have already risen quickly, exceeding many experts' expectations. Mortgage rates have been below 5% mark since 2011, says Greg McBride from Bankrate. We've never seen a run-up in mortgage rates that has been this big, this fast. There have been bigger moves in mortgage rates in the past, but they took significantly longer to unfold. The rates have risen exponentially as the economy adjusts to changes in the face of the pandemic and responds to the highest inflation in 40 years. With interest rates higher than they've been in nearly a decade, there are fewer people who can save money by refinancing to a lower rate. The number of refinances dropped in Q1 of 2019 as rates rose, according to a report from the real estate data firm Adam. The drop-off in Q1 refinancing activity is no surprise with mortgage rates rising as rapidly as they have, said Rich Sharga, Executive Vice President of Market Intelligence at Adam. But many forecasts expected purchase loans to remain strong this year because of rising home prices and continued economic growth, he added. The weakness in purchase loan activity shows just how much of an impact the combination of escalating home prices and increasing interest rates have had on borrower activity this year. In order to address inflation and end the support the economy received during this period of time, the Federal Reserve raised its short-term interest rate. Experts also view mortgage rates increasing as a result of these changes. Rates for mortgages were at near record lows before climbing 10 basis points in just a few months with weekly jumps. Home prices are rising. When considering your mortgage rates, it's also important to consider real estate market trends. Data from Realtor.com found the median U.S. home listing price was $447,000 in May, the highest ever. That's up 37.8% from May 2019. Experts say the big uptick in prices is due to a mismatch between supply and demand. There are a lot of people trying to buy houses, and there aren't enough houses to go around. That means you probably shouldn't wait around and hope for the market to crash. Instead, be strategic and patient with your home search. I don't think consumers should be betting on any really significant price declines, Robert Yates, chief economist at the National Association of Home Builders, told us. If anything, as interest rates move higher, the cost of buying a home is going to go up. Experts say the rising mortgage rate is likely to take some buyers out of the market, but that may not cause prices to fall. It is more likely to result in an increase in prices, just at a slower rate than previously anticipated. You have this continued pressure around purchasing, then even if we see dips, I think you're going to see enough demand in the dips to keep home prices from going down by any true measure. Nicole Ruth, a producing branch manager with the Ruth Team of Fairway Independent Mortgage Corp, told us, "I think the appreciation is going to slow back down to where a normal appreciation should be." The forecast predicts that housing sales will fall by 6.7% in 2022, with median home prices rising by 6.6% over the same time period. This would be an expected result for America's market as it slows down, but there appears to be a small ray of light for buyers. How do I find the best mortgage rate? It's about knowing your goals and picking the right tool. The best mortgage rates for you may not always be the one with the lowest interest rate. Factors like how long you keep your home loan will impact your decision. If you want to keep your home loan long-term, then a fixed-rate mortgage is best. Mortgage rates are currently very low thanks to the Federal Reserve's balance sheet experiment and another burst of competitive interest rates. But if you need to get rid of your home in the next few years, an ARM, adjustable rate mortgage, may be able to save you money by ramping up or slowing down the payments. What determines mortgage rates? Mortgage rates are influenced by the same factors that influence home prices like demand, inflation, and the job market. The best indicator of whether rates will increase or decrease is the 10-year Treasury bond rate. When the bank gives out a loan, it combines all of its other loans, creating a mortgage-backed security (MBS). The MBS is then sold to investors to give the bank more money to be put towards new loans. A bond and a 10-year U.S. Treasury bonds are both investments that compete for the same buyers, and so the rate for both moves up or down in tandem. Learned a lot for today's video? Want to learn more about these interesting topics? Then click the notification bell once you have subscribed to our channel. What are your thoughts about real estate mortgage rates of 2022? Comment them down below. That's it for this video, core member. Once again, remember to subscribe to our channel, and if you feel like we've delivered value, please share this video with one person. That's right, just one person as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you soon!